So the following were included in the assets and liabilities of the New Era Gym and Health Centre Limited on the 1st of the 1st, 2011. Buildings and grounds, €520,000. Equipment, €75,000. Vehicles at cost, €60,000. Stock in shop, 3,600. Stock of heating oil, 1,800. Creditors for supplies to gym and health centre, €1,500. 5% investments, €40,000. Contract cleaning prepaid, €300. Clients' deposits paid in advance, €5,000. The authorised capital of the company was €400,000 and the issued capital was €350,000. All fixed assets have 3 years accumulated depreciation on the 1st of the 1st, 2011. The following is a receipts and payments account for the year ended 31st of the 12th, 2011. So there we have the receipts and payments. Receipts are on this side and payments are on this side. The following information and instructions are to be taken into account. Number 1. Closing stock at the 31st of the 12th, 2011, shop, €1,600, heating oil, €400. Note 2. Cleaning is done under contract payable monthly in advance and includes a payment of €700 for January 2012. 3. Clients' fees include fees for 2012 of €5,500. Clients' fees in arrears at 31st of the 12th, 2011, €600. Note 4. Wages and salaries include €20,000 per annum paid to the secretary, who also runs the shop. It is estimated that 40% of this salary and €300 of the light and heat, €900 of the insurance, and €400 of the telephone is attributable to the shop. Note 5. Creditors for supplies to the gym and health centre at the 31st of the 12th, 2011 are €2,000. Note 6. Electricity due on the 31st of the 12th, 2011, €340. Note 7. Depreciation to be provided as follows. Buildings, 2% of cost for the full year. Equipment, 10% of cost for the full year. Vehicles, 20% of cost per annum from date of purchase to date of sale. The vehicle held on the 1st of the 1st, 2011 was purchased on the 1st of the 1st, 2008 and was traded in on the 1st of the 7th, 2011 against a new vehicle. The trade-in allowance was €8,000 against a new vehicle valued at €48,000. Note 8. On the 31st of the 12th, 2011, the New Era Gym and Health Centre Limited decided to revalue buildings at €850,000. Required, Part A. Calculate the company's reserves, profit and loss balance on the 1st of the 1st, 2011, 18 marks. B. Calculate the profit or loss from the shop for the year ended 31st of the 12th, 2011, 10 marks. C. Prepare a profit and loss account of New Era Gym and Health Centre Limited for the year ended 31st of the 12th, 2011, 36 marks. D. Prepare a balance sheet on the 31st of the 12th, 2011, 30 marks. And E. The company now wishes to purchase equipment for the new extension. Advise the company on how to fund the expected cost of €150,000 for 6 marks. So that is 100 marks altogether. So required, Part A. Calculate the company's reserves, profit and loss balance on the 1st of the 1st, 2011 for 18 marks. So that is just a list of all of the assets minus a list of all of the liabilities on the 1st of the 1st, 2011. So remember that we read out earlier on, all fixed assets have 3 years accumulated depreciation on the 1st of the 1st, 2011. So on the 1st of the 1st, 2011, we want to know what the net book value is. So the cost here minus 3 years accumulated depreciation on the fixed assets, which are the buildings and grounds, the equipment and the vehicles. So remember we read out note 7, which said that depreciation is to be provided as follows. So the buildings 2% of cost, equipment 10% of cost and vehicles 20% of cost. So 3 years depreciation on the buildings and grounds would be 520,000 by 2% by 3 years, which is 31,200. 3 years depreciation on the equipment would be 75,000 by 10% by 3 years, which is €22,500. And then the vehicles, 60,000 by 20% by 3 years, which is €36,000. Then we have the stock in the shop, 3,600, stock of heat and oil, 1,800, creditors for supplies is a liability, 5% investments is asset, contract cleaning prepaid is an asset, clients' fees paid in advance, so clients' fees prepaid is a liability because we owe them the membership. Then the issued capital is the liability. So the authorised capital, we don't put this in here because this is just what we are allowed to sell up to. We will record this information in the balance sheet, but we're only going to actually record in part A what was actually sold. So how much money New Era has actually received from the issue of shares, which is €350,000. So our statement of reserves on the 1st is going to look like this. From just the first paragraph, we just slot in our items. And then what we need to do is we need to look at the rest of the question and see, are there any other assets or liabilities hiding out in the question anywhere else? You will see there on the receipt side that you have balance at bank, €6,500. So that is a positive bank balance figure. So that is going to be an asset at the start of the year. So the 1st, 2011, bank 6,500. Then back to our receipts and payments. Hopefully you might see on the payment side that we have repayment of 30,000 loan on the 1st, 2011 with 15 months interest. So how do I know that this is a liability on the 1st, 2011? Well, I know it is because this loan was repaid on the 1st of April 2011 and it had 15 months interest on it. So 3 months, they had the loan for 3 months of 2011, but they would have had it for 12 months of 2010. So on the 1st, 2011, New Era has had this loan already for 12 months. So 30,000 is the loan. All right, and then 6,000 is the interest for 15 months. So we'll have to work out, so 6,000 divided by 15 and multiplied by 12 months is the amount of loan interest that would have been owed then at the start of the year. So they had the loan for 12 months of 2010. So 6,000 divided by 15 multiplied by 12, 4,800. So altogether there, the reserves on the 1st, €226,200. So that is part A complete. Part B, calculate the profit or loss from the shop for the year ended 31st of the 12th, 2011 for 10 marks. So we want to look for the word shop throughout this question. Okay, and we would just highlight any items that we see there. So we have shop receipts, 42,000, so that's your sales there, less cost of sales. We have our opening stock up here, 3,600, plus our purchases, minus our closing stock, 1,600. That is cost of sales, 28,000. That is gross profit, €14,000. Then we want to take away the expenses. So we have less expenses. We have wages and salaries. So 20,000 multiplied by 40% is €8,000. Then we have 300 light and heat. Then we have 900 insurance. And then we have 400 telephone and broadband. So altogether, that is €9,600 there. So overall, the profit from shop, €4,400. So that figure, €4,400, can go into our next part, which is our profit and loss account. So that profit that we made is going to go straight into our income here, 4,400. Now you'll note here I have ticked off a few items. So I've ticked off the balance at bank. We use that in part A. And I've ticked off the shop receipts because we've used that and we've put the profit in here. And what I've also done is wrote BS balance sheet beside any balance sheet items here. So we do not want to put balance sheet items into the profit and loss account. All we want to put into the profit and loss account are expenses and revenues. All right, so we're going to start on the receipts side and we're going to find any other expenses or revenues to put into our profit and loss account. So next item here we have is clients' fees. So 320,000. We scan up at the top and see if there's anything got to do with clients' fees up here. We see clients' deposits paid in advance. So clients' fees paid in advance, that relates to this year. So the first we have clients' fees prepaid. That relates to this year. So we plus €5,000 there. Then we go down to the additional information and we have in part 3, clients' fees include fees for 2012 of 5,500. So that is next year. So we do not want to put that into this year's accounts because it relates to next year. So we minus 5,500. And then clients' fees in arrears, which just means clients' fees due. So clients still owe us money. At the 31st of the 12th, 2011, €600. So we plus €600 there. So altogether we have €320,100. Then we have investment income. Now this is what we have received, but what we want to put in is what we actually should have received. Now up here we saw earlier on that we have 5% investments, €40,000. So €40,000 by 5% is €2,000. So that is the investment income for the year. This is what we have received. We didn't have any information about any other investment income due at the start or at the end of the question. So we know then later on in our balance sheet we will have 1,100 investment income due in our current assets. If you wish, you can have your balance sheet written out, the layout done, at the same time as doing the profit and loss, and you can be slotting in figures as you wish. So you can do that at the same time also, but hopefully you won't forget to put it into your balance sheet. So moving over to the payment side, we have laundry. Now there were no notes on laundry anywhere else. Then telephone. Now I know some of my telephone was used by the shop, so 400 of the telephone is taken away here and we have 1,000 in the telephone. Then we have wages and salaries. Now the only note that we've already seen is that 40% of the secretary's wages, 20,000, is going into the shop. So 84,300 minus 8,000, 76,300. Then we have the loan. So the loan interest. So we've got 3 months of 2011. So €400 by 3 months is €1,200. Then the next 3 items are balance sheet items. Then we have contract cleaning. So we have the cleaning 3,400, but up here we have contract cleaning prepaid. That relates to this year. So the start of the start of the year, we have contract cleaning prepaid. That relates to this year, so we add that in there. Then we have note 2. Cleaning is done under contract payable monthly in advance, includes a payment of 700 for January 2012. So that is contract cleaning prepaid at the end of the year. It does not relate to this year, so we minus the 700. So altogether there we have €3,000. Next we have light and heat, 3,300. So we've got our 3,300 here, and then we have our stock of heating oil, €1,800. So imagine your oil tank out the back, €1,800 worth of oil in it. Are you going to use that this year? Yes, you will. So we add that 1,800 here. Then we scan down through the question. We see next in note 1 that we have heating oil here, the end of the year, closing stock heating oil. Have we used that? No, that's sitting out in the oil tank at the end of the year, so we haven't used that this year, so we minus the 400 here. Then we keep scanning down and we see that in the wages and salaries and all of the expenses that are attributable to the shop, we have 300 of light and heat were attributable to the shop, so we minus that 300 here. Then in note 6 we have electricity due on the 31st of the 12th 2011, €340. So we add that €340 here. So altogether that is €4,740 for the light and heat there. Then we have insurance. So the insurance is €6,200. And the only other note on insurance was that 900 of it went to the shop. So 6,200 minus 900, 5,300. Lastly, we have purchases of supplies, 34,600. So 34,600, we look up at the top of the question and we see creditors for supplies to gym and health centre. So at the start of the year, we owe people. When did we purchase those items? We purchased them last year. So we are going to take them out of this year's accounts. So we minus 1,500 from there, and then the creditors for supplies at the end of the year in note 5 are €2,000. So we are going to plus the €2,000 there. So altogether there, that is €35,100. So that's all of our items done here. Now we scan down through the additional information and see, is there any other expenses that we haven't seen that need to go in. So we see here in note 7, we've got depreciation. We're told to depreciate fixed assets, and also there we have a vehicle, the vehicle that was held. So this 60,000 vehicle, that should only say vehicle, it should not say vehicles if it tells us down here the vehicle held. So there's only one vehicle and it was €60,000. Was purchased on the 1st of the 1st 2008 and was traded in on the 1st of the 7th 2011 against a new machine. The trade-in allowance was €8,000 against a new vehicle valued at €48,000. So we've got 3 items of depreciation to do, and then we have to work out, was there a profit or loss on sale of that vehicle that was held. So let's do the buildings first. So we've got depreciation of buildings. So we have 520,000 plus our 220,000. Multiply that by 2% and we get €14,800. Next we have equipment. So equipment, €75,000 plus €20,000 multiplied by 10% is €9,500. Then our vehicles is going to be a little bit trickier because we traded in the old vehicle halfway through the year. So the first half of the year we had a vehicle worth 60,000, and then the second half of the year we have a new vehicle worth 48,000. Now you can see here that this says that we paid 40,000 for a new vehicle. That is right, but don't use that figure here. We did pay 40,000 for a new vehicle because we had a trade-in allowance of €8,000. Okay, but the new vehicle actually costs us 48,000 and we have to calculate depreciation on the cost. So when we work that out, we have €10,800. Now we'll work out, did we make a profit or loss on sale of delivery van? So we have to, from the cost here, so the cost was 60,000. We have to take away the accumulated depreciation on the delivery van. So the cost was 60,000. We had that old van for 3.5 years because you can see it was purchased on the 1st of the 1st 2008. So they had it for 2008, 2009, 2010, and then for 6 months of 2011. So that's 3.5 years, and we multiply that by 20%. That is €42,000 that it was depreciated by over those 3.5 years. So 60,000 minus 42 is 18,000, and then the allowance was 8,000. So there is a loss there of €10,000. So we tot them all up and there is a net profit for the year, €115,760. Then we add the reserves from part A, which was 226,200, and we have a profit and loss balance then 31st of the 12th 2011, €377,960. Next, part D, we have to prepare a balance sheet on the 31st of the 12th 2011. So that is 30 marks. So what is a balance sheet? It is a list of all of the assets and all of the liabilities at the end of the year. So all of our fixed assets are our assets that are going to bring us value for longer than 1 year. Current assets, less than 1 year. Creditors, amounts falling due, less than 1 year. And then we have our financed by, which is all our long-term liabilities. So If we start at the very top, we've got our buildings and grounds 520, but we must remember we got a new extension 220,000. So that brings us up to 740,000. Remember we had 3 years accumulated depreciation, and then in note 8 it says on the 31st of 12 2011 the New Era Gym and Health Centre decided to revalue buildings to €850,000. So we slot the 850 into the cost, there's no depreciation, and then the net book value is 850,000. Now, the difference between the cost, which is 520 and 220, which is our 740, so it's difference between 740 and 850 is 110,000. So that is the difference between the cost and the new value. And we slot that into the revaluation reserve. And what is this 46,000? This 46,000 is the 3 years accumulated depreciation plus the depreciation that we just entered in the profit and loss account. So you can write them in separately or you can write that in together. So altogether €156,000. Then we have equipment, and remember we bought 20,000 new equipment then during the year as well, so €95,000. Then in our accumulated depreciation, we have the 3 years accumulated depreciation here, plus this year's depreciation from the P&L. So altogether, that is €32,000. So 95,000 minus 32,000 is €63,000 in the equipment there. Next, we have the vehicles. So the vehicles, we had one vehicle, so this is misleading here. This is vehicle at cost, €60,000. We sold that €60,000 and we bought one for €48,000. It is not the 40,000 that's here. That's just how much we paid for it because we got an allowance of €8,000 there. So the cost of the vehicle, €48,000. Then our accumulated depreciation. So our accumulated depreciation for 3 years was €36,000. Then what we do is subtract the depreciation on the old vehicle that was sold, which is €42,000. And then you add the depreciation charge for the year, which is €10,800. So altogether then, your accumulated depreciation is €4,800. So net book value there, €43,200. The next asset here that we're going to have at the end of the year is our 5% investments, €40,000. Now, while we're on the subject of investments, we should think about, is there any investment income due? And you remember earlier on in the P&L, we said we should get 2,000 for the year, but we only received 1,100. So therefore, investment income due, current assets, €900. So we still have yet to receive this. Next then, we have authorised and issued capital. So ordinary shares authorised 400,000 and issued 350,000. Then we have balance at bank. So this balance here is going to be brought down on the credit side, which is a bank overdraft. So 108,600 bank overdraft. Then note 1, we have closing stock of shop and closing stock of oil, which are current assets. Note 2, we have contract cleaning prepaid. Note 3, we have clients' fees include fees for next year of 5,500, which is a liability. So clients' fees prepaid, 5,500 under liability. Then clients' fees due in current assets, €600. Then note 5, creditors for supplies to the gym and health centre are €2,000, so that is a liability. Then we have electricity due, €340 at the end of the year as well. The last thing that we have to do is bring in our profit and loss balance, 377,960 from our part C, and then just tot everything up, and hopefully our total net assets and capital employed should be the same, and in this case they are, €883,960. So that is the balance sheet complete there for New Era Gym and Health Centre Limited. So the last part then is part E, and that's a bit of theory. So the company now wishes to purchase equipment for the new extension. Advise the company on how to fund the expected cost of €150,000. So what type of thing should we be looking at here? In service firm accounts, the theory always kind of looks at questions such as this. Okay, so just beware, take note of that whenever you're doing that. But how would we fund the expected cost of 150,000 for a new extension? So sell the investments, €40,000. Sell the remaining shares, €50,000, so that's €90,000, and then borrow €60,000. The company would be able to pay back the loan quickly, as the accounts show that it had a surplus of €151,760 in 2011, and the company is generating enough cash. Although it owes the bank €108,600, it has paid out amounts up to €310,000 on non-recurring and non-trading items, such as the new extension, the new equipment, and the new vehicle. So in this case, you're not asked can they afford it or not. You don't have to make a decision. You're just told how will they fund this.